Today's stocks finished with another loss after some really bad employment numbers. So interesting to see the market reaction. We're going to break that down, what that means, with two bad days in a row of jobs numbers, and how did the market react and what does that tell us? I'm going to break that down. I'm also going to kind of break down, this how this week's bearishness, at least over the past few days, compares to what we've seen before. And then what we can expect to see now going into next week, coming off a week like this. Are we going to continue to roll over like everyone thinks we will? Are we done with the bounce up to whatever gap we needed to fill? So those are the things we're going to talk about in today's video. We're going to take a look at quite the move in crude oil and the dollar and bond yields to see what picture they tell us and how that impacts our expectations on how much more bearish we can get from here. How that relates to other instances in the past. And then our trade idea looks at a high probability bearish trade right now, similar to what we did before in other market outlook videos, and how we can trade that, even with the increased risk. So let's go ahead and get started. Today is Friday, April the 3rd, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's go ahead and get started and take a look at the market forecast indicator with the S&P 500. You'll notice here we had a third down day. In fact, interestingly enough, in 2 straight days, we had some pretty negative employment reports. The jobs number, unemployment rate today. I talked quite a bit about that in my technical analysis class today. But obviously the jobless claims numbers from yesterday, and despite those two really bad numbers, we actually closed 18 points higher in those 2 days than where we closed on Wednesday. So interesting how the market doesn't seem to be fazed yet by those realities of course, when you price in a 35% drop in 4 weeks, you're pricing in a lot of bad data. So a lot of that data might already been priced in. A 35% drop in 4 weeks. And keep in mind, I think I mentioned to you this before in these videos, that bear markets typically drop 35% on average, and typically take months for that to happen. And we did it in 4 weeks. So, so consider that the market has brought forward a lot of declines for a lot of bad news. And it's pulled it forward into this 4-week period. I mean, consider like a lot of selling just scrunched up together in 4 weeks. So also consider the jobless claims. We've had 9-10 million jobless claims, 700,000 jobs lost. Consider months worth of jobless claims compressed so far, pulled forward into a couple of weeks, and that's what the market's priced in. That something like that would happen. Otherwise, it would have taken a lot longer to get 35% drop. This would have taken weeks instead of a few days. That would have taken weeks instead of a few up days there. So the reality is, again, that's a significant drop, and it's pricing in some significantly bad numbers, and which we've got in the last couple of days, and the market shrugged at those. You can see I've got the Fibonacci lines drawn on this near-term rally. So this near-term pullback that we've gotten so far on the blue line, below 50, but still above 20 and bouncing up today, as a matter of fact, and pulling back towards Fibonacci retracement zone of that previously bullish near-term rally. So pretty potential. I mean, you get a little bit of an engulfing pattern, bullish engulfing pattern yesterday, a Harami pattern today. So a couple really short to really short term. The reliability goes way down on these short term signals, but bullish when you combine them with the near term line and the Fibonacci, there's an opportunity that we might get light green shading really quickly, which again means that the intermediate lines turned up. Most likely because the near-term lines continued up, and most likely again because we made a run to fill in this gap that we had on Wednesday morning, to finish filling in that gap and potentially retest these old highs, and by then potentially the 30-day moving average at that point. So something to keep an eye on for next week. Again, the high probability trade that everybody's talking about is that we'll come back down, and we have a strong bearish posture. We have market sentiment dropping. In fact, if you look at the Russell 2000, we very, very, very nearly produced. Yesterday it was the momentum line and the intermediate line that stayed above 20. Today those two dropped below 20, but the near-term line bounced up above 20. So, if it wasn't for that near-term line, we'd have a cluster on the Russell 2000 that we just don't get very often. We got a bunch of them. If you were to go back here to 20 years, if you look, see, okay, when was the last time we got these clusters? They included the market sentiment. It was in December of 2018. Of course, the big rally we had out of that low point. Before that, all these clusters, none of these included the market sentiment line being in there too. We got really, really close right here. The market sentiment closed at 20.44 on that day in 2015. So we have to go all the way back to, I believe it was 20, not even there, so we came close. But it was October of 2011. And then that ended up being, if you notice, October of 2011. Here, let me change this up here. Fit the studies and use log scale. And I'm just going to actually, no, I'll do it in a second. You notice that ended up being the low point on the Russell. From that low, we took off from that point. Now, obviously, we got clusters along the way in the pullbacks, but we took off from that point. If you look at other time frames here, you can see all the way back in 2009, we didn't get a cluster in March of 2009. So over here, none of these had the market sentiment line above it, but in November we did. So in November, these two clusters occurred. So, that's the last time we've gotten these clusters. It's very rare to get the signal that we came very, very, very close to getting today. And if we were to have kind of one big hurrah sell-off on Monday and close at the low, which is getting harder to do. And again, that's the topic. That was my topic of today's technical analysis class. Again, if you like these videos and you kind of want a deeper dive into how I look at charts, every Friday 1 p.m. I do a technical analysis class, kind of a master class, so to speak. Where I kind of show you things, especially different indicators that are more relevant to the time. And today we kind of talked about this how these lows form and this little second stage of selling, wave of selling we're getting now, how we can read that using the stochastic indicator, and how we can use that indicator to scan for some bearish and bullish opportunities like we will do today in today's trade idea. So again, that's all the monthly subscribers and premium subscribers get access to that class. The premium subscribers get access to all the charts that go along with it. So all these charts that we use, and like, for example, the custom scans that we created today, I post for premium subscribers. So that's kind of the difference there. But you can kind of see, we had a little bit of a pullback towards the end of the week because we were down this week, that we opened up bullish, and then we came down from Monday's high. But we didn't go down too far, and that's a really, really good sign, and the potential for a bullish near-term low, the first bullish near-term low, and the potential of an equal and bullish near-term high point coming out of that is an interesting development that we'll definitely keep our eyes on here. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below this video. That will notify you when these videos are posted. Hit the thumbs up icon down there. That lets us know two things. Number one, you liked our video today. Number two, you want us to do it again Monday. It's a quick way to give us feedback. We check how many likes there are because, again, that tells us what you're thinking. If you don't like our videos, you don't have to click on anything down there. But if you do, you can click on that right now and let us know. Again, the more likes these videos get, the more YouTube promotes the videos. So it's a win for us too in that regard. Join our while you're down there, comment on anything that stood out to you in today's video. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link. Just subscribe to our site for free. We are sending something out to our free subscribers today to kind of give you an idea of what we do, the kind of classes that we have at Market Scholars that our premium and our monthly subscribers get access to. So make sure that you are a free subscriber for that. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. There's also a really easy way to subscribe if you're watching our video here on our website. Right up here at the top, this blue button, you can subscribe to our site for free up there as well. So anywhere you're at on our site, that will get you there. We also invite you to engage with us on social media. Hit this little heart. It opens up a new window that will like today's Market Outlook tweet. Hit that thumbs up icon, takes you to your Facebook page. You can like your Facebook post there again. That benefits us because of the engagement with these posts. It also benefits you because those platforms only promote the content for the accounts that you follow that you also engage with. So the more you engage with us, the more you'll see our content and other content like the stuff that we post. So we try to make that really easy for you to engage. Also, there's a calendar as well as our Market Outlook live videos. Again, I always get asked about reviewing our previous trade ideas that we've done. And we do that here in the trade review videos. So if that interests you, and I know it does because I get asked, it's probably the number one thing I get asked about from Market Outlook viewers, is to can we go over some of these old trade ideas and how they're doing. So if that interests you, we do those in these live trade reviews. Again, our monthly subscribers get access to those in addition to all of our classes. The only one that the trading rooms, the only one that the classes that they don't get access to that's for our premium subscribers is our weekly pretty much online coaching sessions, our Q&A sessions that we have. I do one every week and Brandon does one every week. All right, let's get back to the charts here. Let's take a look at the weekly chart, and quite the transition candle that we got here. Now keep in mind, if you look at the open and the close, 25.30 to 25.34, so that means next week's Hakkinashi Open is going to be about 25.37. We're currently trading at 24.88. So there's going to be 24.88 is right here. So that's going to be a little bit of a bearish candle right off the bat next week. So it's not, we're not going to start off bullish. And obviously, again, if we do rally, we're going to have a long lower shadow, right? Because we'd have to go through the open. We're already below the open, so we'd have to go up through that. So we're not going to get one of these candles where we don't have a lower shadow next week. So keep that in mind. We also closed to this week below the Hakkinashi close here. So we didn't close below the low point, and that's a good sign. 24.77, we ended up at 24.88. So we closed above the low point, obviously, because the low point is the low point. Excuse me, we closed above last week's close, and that's a good sign for the broader market. On a relative basis, 24.88, closing above last week's close of 24.15. So a positive in that regard, but we're not out of the woods yet, right? We kind of need to start closing above these closes to be really bullish, and we'll see. We'll see if next week we close above 25.34, which is this week's Hakkinashi close. If so, great. Which would take a bullish move right now. If not, then we're going to still have some of these transition candles. You can see the PPO is just starting to pick up. It's at a pretty significantly low level, but it's going to take some time. This is back in 2008. You can see how significantly bearish that was. The reason why the PPO is not nearly as low now as it was then is because we were already pretty bearish by the time we got that selling. If you notice, we were almost this bearish by the time we got that by the time we fell off the cliff. So that's a big difference. In fact, again, that's another reason why it's such a big comparison to 87 and the move that we had there in terms of PPO, because you can see here we were pretty bullish. We were coming down some pretty bullish PPOs by the time we sold off. And so eventually we came down to about this level, which is probably about as deep as we're going to get here as of right now. You can see We got lower over here in 2002, but because again we were already bearish by the time we fell off the cliff in July 2002 during that low point. And here's another low that we got a pretty significant selling in August 2011 at the very beginning of a death cross. So 11 and 87 is a more extreme version of 11, and as of right now, this is a pretty extreme version of 1987 that we're getting here. But the principle is the same, that we probably won't fall nearly as deeply on the PPO because we weren't already bearish going into this. So what that means is we're probably getting pretty close to as low as we are, and combine that with the fact that we're getting transition candles is another sign that this the pressure that was so much selling pressure over the past few weeks. Even though we might retest lows, we might go lower, we just won't have that same kind of rip your face off pressure that we'll see because of how low that PPO already is. Let's take a look at the 3 green arrow chart. Obviously, we have 2 green arrows that the histogram is rolling over. But here's another issue in terms of the past few days. I mean, we've fallen what, 3 of the past 4 days here. When you look at that sell-off, you notice like today's volume was the lowest volume day that we had during this whole week. It was also the smallest trading range. Like we had a 13-point. Yesterday was a 8-point trading range. Today was just barely above that. But pretty much traded inside of that range, as you'll see here in a minute. So keep in mind this bearishness that we've had over the past 4 days. Not a whole lot of volume, and as bad as this news was, right? You would think that would probably get us to jump up above that average volume, and it didn't. When I break these 3 green arrow charts down into their separate components, you can see the MACD histogram is rolling over because the MACD, even though it's above its moving average, is starting to slow down, right? And the stochastics is also starting to slow down, making it very likely that these 2 blue lines will cross down below the orange lines. But again, with the selling, with the peak of the selling behind us, the expectation is, like you've seen on these other oscillators, whether it's the RSI, where here is the peak of the selling, and then kind of a second wave, and now we expect the oscillators to produce higher lows. You look at the DMI, and you would expect the same thing, right? Here's the peak of the selling right here, the worst of the worst, and then we got down to these lower lows, and we were still pretty bearish on these, and now you can see the indicator is still bearish, but not nearly to the same extent, with the ADX falling back below 40. You look at the linear regression. Again, we're still pretty far extended as it is. It was the Ichimoku that I wanted to take a look at. Trend strength, very, very bearish, so we're not done. And if you look at it on a weekly chart, you can see we went from a really strong bullish trend to a really strong bearish trend, just like that. But going back to the daily, you can see that the trend is abating. The strength of the trend is abating. We're not nearly as strong anymore. Keep in mind, if you go back out here, and let's give you some context on this. When we get this really strong bearish moves, you can see you either get the big selling and then we kind of abate as we retest the lows and we turn into bullish, or it starts slow and builds into a crescendo like the bullish moves typically do. You build into a crescendo that you come off of. Right now this is looking like we've had the big sell-off here, and now we start slowing down. Again, you can see another example of that, obvious example of that in here in 2008. 2008, we were bearish. We had some bearish moves, and then we had this kind of crescendo right here in October. A little bit of a lower low, but once we started to abate, we didn't really go bullish. We stayed below the blue line until we crossed over here, and that's where the trend really got weak and got really noisy. So as we stayed below 50, and then finally had one last gasp before we rallied. So very strong trend, but now look for the trend to start really weakening as things settle down. We get closer, so it's going to trade closer depending upon how much lower we go. If we go lower, we're going to start to get closer to this cloud over here. And eventually that will be a good opportunity for a reversal, at least in the intermediate trend, if not, for a run up to that 200-day moving average. But again, that's, we're talking weeks. That's early April or early May by the time we'll even get close to that cloud, by the time we reach that. Let's take a quick look at the intraday chart here, and you'll notice, once it does pull up, there we go. Look at the range. So I mentioned that today's range stayed within yesterday's range, and a little higher high, little higher low, but pretty much you can see how we're really building out, a volume node in this area. So if I were to go out a little bit further, and you can kind of see here, let me go to like a 30-minute chart here, so you can see it all on one. That's a pretty decent node that, we might go down a little bit lower because there's not very much volume below us, and that's why we retest lows. But once you get up above this, you can see how it was going to act as a pretty decent support level, similar to what this would act as a resistance if we were ever even get close to that, which obviously not anytime, you wouldn't expect that anytime soon. So go back to the 4-week chart. So again, that's how much of the gap we have left to fill from Wednesday's gap. You expect it to be filled because it's not really a breakaway or runaway gap here. But you can also see that there's going to be some pretty significant resistance at that level if we were to get there. It makes it, if we were to break through, it's really going to, and talk about like suckering people off the retesting of the lows bandwagon. If we break that 260 resistance, which is now a pretty significant level, and break up through this, it's going to get a lot of people off that bandwagon. And that's probably where, again, the 30-day moving average is well up above that, 280 level. If you look at that 2-line chart here, we're well up above this line. So, you have to start looking at, where is, the 50-day moving average and the 200-day. So if I were to pull this up here, 50, so you can see the 50-day moving average is up to 294. So by the time, so we would be, if we were to really kind of break through that level and sucker so many people out of this, by the time we did that, you're going to be flirting with that 50-day moving average, which will be falling down to those levels. So, don't be surprised if we don't get that kind of move to kind of get more people off that retesting of the lows bandwagon before we fall back over. Otherwise, if we do retest these lows immediately and fill in this gap here for that matter, then it's going to be a grind, right? It's not going to happen very nice, and because again, the market causes pain, and if everybody's expecting something, there's not a whole lot of pain there. Also keep in mind too, if we do come down, this level is going to act as a support, that gap. So the bottom of this value area essentially is going to act as a support level. Again, assuming that that's a runaway gap there. Finally, let's look at the volatility. If you take a look at the volatility index, you can see we're pulled down to the 105% mark. So as I mentioned earlier on Wednesday and Monday, that this VIX has room to fall, and it's fallen. It's fallen all the way down to this 105% mark. There's going to be some support in this area now. There's room for it to still go down, and, we can fall to 100%. There's going to be support there. There's going to be support, even bigger support at the 95% mark. So if we were to kind of sucker people in and fall down towards 40 on the VIX and towards 95% here on the on this VIX ratio chart, then there's going to be some big time support, and again those are things we look at, especially in our options inventory trading room that we do. The other thing I wanted to mention was again, another sign that the selling, the extreme selling is behind us is, we've got the big moves. You see how we've been progressively getting smaller moves, and now we will, right? So this historical, the VIX is not going to jump back up to 100% or 90%. That would be all-time highs again. This is an all-time high for the VIX, and I would be surprised if we got up that high. But the VIX has a good chance of getting back in the 60s, if not the 70s. And by the time, but for that to happen, I'm going to venture to guess you're going to have to get this historical down there first. So it's going to take some time. The the ratio here, you saw the volume being as low as it was, pulling the average down, the range of 8 points. If you look at the range here, 8.1 points out of 248.19. That's 3.25%. So we're getting closer and closer. We won't form the low point until the ATR falls to that 3% mark. As it does, just expect really small moves in the 8-point range or smaller, which is very, very good. The more we get really, really big ranges, then that means we might get another wave of selling. But that's unlikely considering that we've had the biggest wave right now already as we speak. If anything, you might expect months of bearishness and then a big wave to end that. But again, that's more like a 2008 scenario or 2002 scenario when we've already been in the death cross environment for so long, versus say 1987 or 2011 where we were in a golden cross environment and we had this big drop out of nowhere to get us below the 200-day moving average and then stall. You look at that linear regression chart just again as an idea of margin of safety. And again, this on a 5-year basis, very, very very good margin of safety here because we're so extremely low already as it is. All right, before we look at what's driving this price action, I did want to just summarize. So we've hit the apex of selling pressure. We've bounced off of it, and we've had the biggest bounce, right? We've had the biggest upward moves. We're not going to have huge upward moves anymore. But the nice thing is we're also not going to have big downward moves either. And if we do, they're going to, if we do continue to retest lows, it's going to be slower. There's going to be more down days. But there's a lot of good signs in terms of, we've hit the peak of volatility and a lot of these volatility measures, like as I said, I reviewed this quite a bit today in my technical analysis class. That's recorded and archived on our site that you can be able to view there if you click on Trading Rooms in the main menu. But we are now slowing down a lot of those measures, and that's a very, very good sign in terms of like the worst is behind us. Not the lowest low is behind us, but the worst of the selling, you just can't do anything about it type selling is behind us there. So, again, like Brandon and I tweeted on Twitter, we had a little back and forth there. And, I've mentioned on this video before, in 2008, after the worst of the selling was behind us, we still fell 25%. Another 5 months later, between that point and 5 months. In 5 months' time, we fell another 25%. But in the next 7 months' time, we rose so much that the whole 12-month return was 20%, even though the 12-month return started with 5 months of a 25% decline. So the worst of the worst might be behind us, but that doesn't necessarily mean that we've hit the lowest low. So that's, again, we were in a death cross environment, and 1987, Black Monday was the lowest low, even though we retested it, but it was the lowest low. So that right now, that's our best comparison because of the type of market environment that we were in both scenarios. 1929 was also a bullish period, so that's something to keep an eye on too. If and when we do make a run back to the 200-day moving average and we can't clear it and stay above it, then we know what to do because we've seen how the market responded back then. So what do you think? Do you agree with that technical assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that either makes you a lot more bullish than I am, or that you don't think the worst of the worst is behind us? You can share that, whatever charts or indicators that you're seeing. Everybody's got an opinion, right? And especially on the internet, everybody wants to say, oh, the market's going to tank and blah, right? And of course, everybody's got their opinion, but what matters more, what's more valuable, is what drives your opinion. Otherwise, if you just say I am a lot more bearish than you, and that's just because that's how I am, which it seems like that's how people are sometimes in the comment sections of anonymous message boards. but that this is not, it's not as valuable. So share with us what you're seeing, whether it's a chart, whether it's an indicator, that again might be because that might make you actually more bullish than I am. You're right, V bottom right from the get-go here. So share that down below in the comment section. All right, now let's talk about what's driving this price action. I did want to mention here, so let's go to, again, since we bounced off of that March 24th, the 23rd low, what have we done here? And you notice, initially, preferred stocks, real estate, both did really well. That's not surprising. When we're really, really selling off, they tend to bounce up. You notice they're still, despite the pullback, especially in REITs, they're still holding up and doing better because their gains have exceeded their losses during the pullback. So they're still outpacing. The only thing that's different is this real significant jump in crude oil, which is a very, very good sign for the broad market as a whole. Again, we've talked before, we don't need crude oil to go up at least to go up as much as the market. But if it doesn't fall through its floor, that's a really good sign. So if this, if crude oil continues its little run that it's having, and it's had quite the run here, starting a little bit of a bullish run, coming off these lows. We talked about getting up to 35 on crude oil. I remember how we said, what was it, on Wednesday? We said that it can get to 35 for no reason that we don't know about. Well, now we have a reason, a catalyst. But that was just a couple days ago. We talked about the potential for it to getting there, and we're already to 20. Just like that, we went from 21 when I posted that comment in this video up to 29, just like that. And you can see we came off the cluster, the near-term lines up to a pretty decent level. Momentum lines, not to an extreme, but it got really, really close. And you can see the intermediate lines crossing up above the market sentiment line. So we'll see if that continues. Again, that would play out the rest of this divergence that we've been having, get back up to that gap. There will be some significant resistance in that gap area. So I don't expect that we'll get through that area. But you notice, there's actually not a whole lot of resistance until you get up to that 50 level again. So they can go up really fast. It can also turn back around and come down really fast. So keep that in mind. It's getting back into the upper half of the band. It did this briefly before. So we'll see if it's brief again or if it starts a trend reversal in this case. You can also see kind of another sign here on the DMI that kind of shows, this is great, but it's not quite everything we need because the negative index is still easily above 20. Or 25. It's got to get below 20 for us to be really bullish. The positive index has got to get above 25 for us to be really bullish, and it's still below 20, and it's still trying to make its way above 20. So we've got a long ways to go here, but it's a good sign nonetheless. We were just so extremely oversold that the technical environment made it to where and we can get there. We still have some room to get just up to the 30-day moving average in the next day or two. But even then, there's going to be some resistance at that moving average, just like there was over here when we tried this before. Let's take a look at the dollar index because that's the other asset class that's been making some significant moves here lately. The last few days, again, bouncing up, giving us a bullish pattern on the market forecast. And remember, it's hard for stocks to make too much of a rally when the dollar's rising as much as it is. So, is it going to get back up to this level where we have these significant reversal here which helped the market kind of find its bottom? Again, the more bearish this is, the better. So that kind of makes you have to look at something like the Euro US dollar and say, okay, is there a good chance this Euro is going to continue to trend to the downside? And which would be a bullish for the dollar, or is it kind of finding its own low point? There's a lot of volatility right now, and we have been so bearish for so long that I think there's going to be a lot of choppiness and volatility, but usually that leads to a reversal. So we'll see if that leads to the reversal that we're expecting, bigger on the downside, you have the bigger moves than on the upside when you have smaller. But regardless, lots of upper and lower shadows, kind of end a trend here. Even if you look at it on a monthly chart, that's a big reversal pattern in the month of March. This is April. That's a big, a big transition candle on a monthly basis there. Let's take a look at the bond yields too, because that's kind of jumping out at me here lately. Again, they've been so bearish, and they've been held back this week. You can see, we've had a nice this actually rallied before stocks did. The Nat stocks have rallied. Yields really didn't, and they're still kind of retesting some extreme lows. Remember, they got these clusters with the market sentiment line too, which is we've gotten quite a few of these over the last little bit. And you take a look at its weekly chart, and we even got the weekly chart with a cluster with a market sentiment, which is very rare because it's hard to get the here's another examples here of market sentiment being included in these clusters. It's hard for the market sentiment to make such a big run over such a long time frame on a weekly chart. So good cluster these last couple, and we're depending upon we did finish the week here. We came really close to doing it again, to another cluster, kind of trading within this range. Of course, on the monthly chart, we didn't get the market sentiment line down because it takes so long for that to move. But we did get, we've had 2 months in a row of clusters with a long lower shadow here on the monthly. So very oversold on yields. If you take a look at the linear regression for yields, obviously on a 1-year chart, TNX, on a 1-year chart, you can see where it's at and how high the ATR has gotten. It looks like it's starting to peak. On a 5-year chart, extremely low, finishing this week again below the second standard deviation channel of the 5-year linear regression, and also finishing below the second standard deviation channel of the 10-year linear regression. So very extreme, and you can see on a 15-year basis getting down towards the getting down towards the first standard deviation, at the bottom of the first standard deviation channel. So really bearish on yields, and again, for if crude oil starts to rally and yields start to rally, that combination typically, it's an inflationary combination, and typically it's pretty bullish for equities too, for risk appetite as a whole. So definitely a relationship we want to see, if this bearish crude and bearish yield relationship is done, or if this bearishness, this extreme bearishness in both is done, and if they're both ready to at least return to the median, to their extremes, as I showed you on the chart here. Let's just do a regular candle on crude oil. We are that far below the 200-day moving average, and look at that engulfing and kind of a piercing line candlestick pattern there. And then you look at yields being as far below their 200-day. Just to run back up to that would be very bullish for risk appetite, and again, kind of suggests what our margin of safety is to the downside. When we're already so extremely bearish in those other asset classes, it limits the downside we have left to go in equities. Doesn't mean we can't go to a lower low. Among other things, it limits the down. There's other reasons too that if we did hit a lower low, that lower low won't be nearly as low as we might think it would be, because there's that Bollinger Band, right? The Bollinger Band too, on a 5-year basis here, very strong support in this 210, 2100 area on SPX. All right, from a sector standpoint, here's how the sectors have performed. And interestingly enough, again, as bad as utilities and REITs have been, coming off of that March 24th low point, they're still holding up pretty well. Healthcare has done well through the up and the back down again. Energy, not surprising, it's the best performer off of that March 23rd low, up 26% with that jump in crude oil. So a very, very good move for XLE. And you can see our lagging sectors, technology, discretionary. And so we really haven't had a good bounce, a good bullish bounce, right? This was just an oversold, an oversold technical bounce. That's all that was. We haven't had a good bullish bounce yet, which is what would happen if these lagging sectors here were to regain the leadership there. So something to keep an eye on. Just looking at today alone, we were down today, but you can see here that utilities were down the most. Real estate rallied a little bit here. Staples holding up. Some good news from Walmart. Healthcare doing well. But technology, discretionary, communication services, they were down during the selling and then kind of starting to pick up a little bit on the bounce. So we'll see if those your typical cyclical leaders take over the leadership on any subsequent bounce. And again, that would that be enough to knock people off the retesting of the lows bandwagon so that we can retest those lows to the downside and do it in a way that might cause pain for them, for people falling off that bandwagon, but would produce some good returns for us that have been expecting it. All right, so for our trade idea of the day, I wanted to take a look at Nvidia. Nvidia is, has gone up to the moving average, gave us a really good bearish pattern. It's already rolled over, so we can't really get on the high like we did in a few other trade examples. It's already come back down. The intermediate line's rolling over. We're back below the falling moving average. So we have the red line again. So things are looking pretty bearish from that perspective. We have two green arrows, but you can see how we're really, really getting close to two more reds. In fact, if you take a look at the two-line versions of this, the MACD is also really close to crossing back below 0.2. And the stochastics crossing back, has crossed below its moving average. If you take a look at the DMI for Nvidia, similar to what we saw in Oracle, how you had the crossover, and AMD, how you had the crossover, their crossover occurred up below 25, so it's still above 20, but below 25. You can see the positive has fallen back below 20, and now with the negative, you look for it to bounce back above 25, and you got a good reversal pattern here going on. You can see from a Bollinger Band perspective that you're above the value area, and you can see the lack of volume below us if we were to break this level. And again, do we expect that we'll break this resistance to the upside and really take off to all-time highs? And I think the answer to that would be no right now, given the market environment. So while there might not be a whole lot of downside, and we don't know if we'll break the lower lows, some big support down here, but to get down to 210 is a very reasonable level, and pretty quickly too, if it were to, if the markets were to really roll over as well. So we can be able to take advantage of that by doing a call vertical spread, similar to what we did on Home Depot a couple of days ago. So we come over here to the Analyze tab, Nvidia, and you can see that we sold the 265 call and bought the 270. So that gives us, a risk of, excuse me, let me get rid of that one, a full position size risk and about a $500 reward, so about half of that. And again, if we get down to 210, we can get half of that reward, and that's kind of the idea, similar to Home Depot. If we can get, because it's very hard, it's a very risky trade, a lot of risk for a small reward here. But if I can get half of that quickly on a good move, shoot, just getting down to 220 would get us what we need, then I'll take it and move on, right? That's one of the things that we teach is to take those 50% of max gains if you can get it quickly. So we don't, again, you can see how fast you can get it and then how slow it takes to get the other 50%. It takes a long time to get the other 50%, really quick to get the first 50%. So we'll grab it and take it and move on to something else, or look for some bullish opportunities after we're to drop down like that. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forum. And one of the things you get on our site for free, you get access to that forum. The rest of our community, especially for our classes, is for our premium subscribers, but our free subscribers get access to the Market Outlook forum. So communicate, open up any threads with any questions or comments on anything that we covered in today's video. Reply to other people's threads. let's keep this conversation going here. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below, follow me on Twitter for more content between the videos, join our Market Outlook community that we created on Facebook as well as here at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all on Monday.